Hello, good morning, everyone. Good morning, business world. So, I hope you're doing fine at the comfort of your home. So, today we're going to be discussing chapter 8, which is all about notes payable. Okay, so before we dive into the depth discussion of notes payable, let us first have a short recall of what is note payable according to our discussion in previous subject courses. Okay, I believe notes payable is not new for us. We have encountered this account title countless times. And I think it was introduced to us in Fundamentals of Accountancy Business Management 1 and 2 if you took Accountancy Business Management strand. And if not, it was also discussed in Financial Accounting and Reporting 1 during first semester in first year. So um I think you have already knew what does notes payable, okay? But okay, so accordingly, notes payable is presented by a promissory note. Okay, promissory note which is issued by the business to its creditors for money borrowed or merchandise and other assets both on credit. Okay, at simplest sense, it is actually utang. Okay, we record this one or have an entry if there is an utang. Okay. So what is the difference and similarity between accounts payable and notes payable? So since we have mentioned utang, okay. So the similarity between the both payable is that they are trade payables. So what do you mean by trade payables? Trade payables are payables that arises in the um what do you call this one? Um Trade payables, actually the payables that arises in the ordinary course of the business. Like for example, if you are a manufacturing company and you manufacture pencils, okay? So from the time that you bought inventories, so of course you bought inventories to produce pencils. So those inventories are assets held for sale in the ordinary course of the business. And if you bought that inventories without paying cash, okay, so there is a trade payable. Okay, the trade payable might be accounts payable or notes payable. That's the similarity. Okay, both of them are trade payables. So the difference is that accounts payable is okay, notes payable is presented by a promissory note. Without promissory note, we cannot recognize it as a note payable. Okay, so like for example, a transaction, a problem. If the problem is silent or you have credit, but it doesn't state if there is a promissory note, we assume directly that it is accounts payable. Okay, so if it is silent, we assume that it is a accounts payable. But if the transaction states that the entity uh have a credit which presented by a promissory note, so basically we will going to recognize it as a note payable. Again, the similarities is that both payables are trade payables, and the difference is that note payable is presented by a promissory note. Actually, the it is more advantage to have a note payable or to have promissory note because promissory note serves as a evidence. Okay, there is the evidence of an agreement between both parties. Okay, the maker and the payee. No, so that's the advantage of notes payable. Okay, so So let us have now our technical knowledge about notes payable. Okay, but before anything else, I would like to add something. Okay, so if you have really understood the concept in chapter 5, 6, and 7, this is gonna be an easy peasy for you since those chapter is connected in notes payable. What do I mean? What do I mean by that? Okay, so in chapter 5, which is bonds payable, it shares some similarities with notes payable, since they are both what do you call this one? Financial instrument. Okay, they have similarities when it comes to measurement and other concepts. Okay, in chapter 6, we discuss the effective interest method. So it is also it is also advantage if you have really understood chapter 6, since we also apply this effective interest method in the note payable. Okay, so the last one is chapter 7, which is all about financial instrument. As what I said earlier, that notes payable is a financial instrument, specifically a financial liability. So if you have really understood those three consecutive chapters, so this is gonna be an easy peasy squeezy for you. Let's have our technical knowledge. So our technical knowledge serves as our objectives for our discussion in notes payable. So we have to define a promissory note. As what I said earlier, okay? Promissory note elevates, or it gives the recognition of note payable. Without promissory note, we cannot recognize it as a note payable. So it means that promissory note serves a vital role in note payable. Okay? So the second one is to know the initial measurement of no payable. So the initial measurement is gonna be the first entry measurement of notes payable. So how do we measure notes payable at first? Okay, that's the second objective. So the third objective is to understand subsequent measurement of note payable at amortized cost. So after initial measurement, so how do we subsequently measure note payable at amortized cost? So we are also going to apply this amortization, okay? Amortized cost. Okay. So the fourth one is to understand the fair value option of measuring note payable. Same with bonds payable, they also have this fair value option. So we're gonna be tackling this fair value option in the notes payable. And the last one will be to know the accounting for note payable issued solely for cash, interest bearing note, um, interest bearing note payable, and non-interest bearing note payable issued for property. Okay, so it means that there is interest bearing note payable. There's also non-interest bearing note payable. So we're gonna discussing that, okay, later on.